Welcome back, class. So this is a follow-up to the live lecture that we had this week on Chapter 15. There were two more problems that I had pulled from your homework, and I wanted to make sure that we had an opportunity to go over them as a class, and we just simply ran out of time. And I thought, well, I still want you to see at least one example of each problem before you try to tackle the homework for Chapter 15. And so this shouldn't take very long. This video should be short and sweet. Just want to demonstrate just a few more things so that you can be successful on your homework and quiz. All right, so this problem here talks about commercial paper, which is another method for companies to raise capital in the short term. All right, and so the problem reads, Serial City Instruments will issue commercial paper for a short-term cash inflow. The paper is for 182 days, has a face value of $50,000, and is anticipated to sell at 94% of par value. This is also referred to as the discount rate. Serial City wants to raise $5 million in capital. So what is the cost of borrowing annually, and how many papers must they sell? All right, so as always, let's start out with our data table and let's see if we can figure a few things out. So first off, the paper is being issued for a 182-day period, which is not like an exact number, is it? It doesn't really um, round out to be any specific time measurement other than in days. So we're going to define it in days, right? And so, because we already know at the end of the problem it's asking for an annual rate, right? The cost of borrowing as an annual rate, then we probably need to determine what is this holding period in years? How many holding periods do we get in a year? And that's not hard to do, right? We just take the number of days in a year and we divide it by the holding period, right? And so what we find is that there are exactly 2.01 holding periods per year. What does that mean exactly? It means that if we took this number here, multiplied it by 2.01, we would get 365 days or 1 year. And we're going to use that information in just a moment. Now, the next piece of information is the face value. Just some vocabulary for you. Um, the future value is the face value, is the par value, is the maturity, not maturity, sorry, maturity value. So these terms are all synonymous, okay? And what exactly does it mean? Well, what it means is that when an investor purchases one of these commercial papers from Serial City, they are going to purchase it at a discount, which is subpar, below par. Okay. But the idea is that after they purchase it, that piece of paper, that commercial paper, will be bought back by Serial City at a later date at a higher or par value. And so the interest that is being earned on this investment from the investor's point of view, right, from the investor's point of view, is however much money they gain from holding this piece of paper, this commercial paper, right? And so we're going to calculate how much they pay for it, and then we're already told how much Serial City is going to buy it back for. And the interest is the difference between the two. Okay, so when we're told par value, that is the amount that Serial City is going to buy the paper back from the investor for, and that's the $50,000, and that's per commercial paper. Okay, that's each one. All right, then we're told that the commercial paper is going to sell at 94% of par value. That's how much the investor pays for it today. Okay, and we're given it as a percentage, so we need to be able to put that into our data table to make a calculation. So we're going to put in 0.94. And after we have that defined, we can then calculate how much an investor would pay for one of these commercial papers. We're going to say, all right, the par value times the discount rate. Okay. And so what we find is that an investor, okay, let's see if I can draw a timeline out for you. is going to buy one commercial paper, right, today at time zero, all right, they're going to pay $47,000 today, and then they're going to hold it. Let's see. There we go. And then they're going to hold that for 182 days. At the end of those 182 days, Serial City is going to buy it back. That's the agreement. You know, you buy this from me, I buy it back from you at a later date. And when they buy it back, they have to buy it back. They've agreed to this, that they're going to buy that same piece of paper back for $50,000. And so for each individual commercial paper, the investor, right? The investor is generating a profit, right, of 50,000 minus 47. So they are making $3,000 in interest per commercial paper. All right, so that's how much they are making. Okay, so so this is how much they're selling for in today's terms at time zero. And so the problem says, well, hey, we're trying to raise $5 million. Well, that's more data that we need. All right, so we're trying to raise $5 million. And we know that those papers are being sold at $47,000 per paper today. And so the question is, how many papers do we need to sell? Well, this is simple math, right? We're just going to take that 5 million and divide it by the 47,000. And we get an offset number, right? 106.38. Well, in case you were wondering, you cannot sell 0.38 of a paper. You also cannot reach your goal if you sell less than that. So what we must do is we must round up. So therefore, Serial City must sell 107 commercial papers in order to meet its funding goal. Okay, so that's the answer. The answer is actually 107. 107 is the answer for that particular problem. And then it says, what was the cost of borrowing in annual terms? This is where it gets a little tricky. This goes back to chapter 5, I believe it was. So remember, we can always calculate the return for any holding period and then take that holding period return and convert it to an APR and then to an effective annual rate. So let's try that out, right? So first off, the holding period return is very easy, and we've done this before. All you do is you take the new value, you subtract the old value, and then you divide by the old value. And then remember, put that numerator in parentheses because you have to tell Excel the order of operations, right? So you have to force that numerator, the subtraction, to happen first, all right? And so what we get is we get a holding period return of about 6.38%. All right, that's not too bad, right? However, our holding period was not a year. So that means that we need to calculate the annual percentage rate, right? The annual rate of return. Well, we've already determined that there are 2.01 holding periods per year. And so we can take this interest rate here that we calculated as a holding period return and multiply it by the holding periods per year. And so what we get is that an investor who invested in this commercial paper would have an annual percent rate of about 12.8% per year. Okay. And then if the problem were to say, well, what was the effective annual rate? I don't even think this one asks for this, but you might get a problem that does. Well, we can calculate that too, right? We can say, all right, well, 1 plus the periodic rate, right? And remember, the periodic rate is the holding period return, not the APR. Okay. And we're going to say, all right, that raised to the holding periods per year, right? And then close parentheses minus 1, and we get an effective annual rate of about 13.21%, which factors in the effects of compounding, right? And so these are all the different returns that we can associate with this investment. All right, so that's that example. Let's hop over and do one more for this video, short and sweet. So we've already done a problem like this. We did a problem like this earlier in our live lecture. However, at the end of this chapter, the chapter focuses on the auction, right? The auction when a company decides to sell securities in the form of stocks for the first time in an initial public offering. And there's some additional details in the chapter that talk about, uh, the green shoe provision. It also talks about the pro rata ratio of determining how much each bidder gets if there's not enough stocks to go around. If this does not sound familiar to you, you either need to go back and read chapter 15 or go watch my PowerPoint lecture. But this problem kind of throws all those different scenarios into one problem, and it's probably going to be the most difficult problem that you run across in your homework, especially if you have not reviewed the PowerPoint or read. It's going to be a little confusing, so I thought, hey, let's do this one as an example so that the students can figure it out on the homework. All right, so Bruce Wayne, Batman, has decided to go public with his new business. Berkman Investment Bank will be his banker and is doing a best efforts sale with a 4.5% commission rate. And I'm just going to document as I'm reading. So 4.5% commission. All right, the SEC has authorized Wayne Enterprises to sell 5.12 million shares for this issue. So now we know what the authorized number of shares is, right? So we're going to type that in, 5120. All right, so that's the number of shares that we are authorized to sell. He, as in Bruce Wayne, plans to keep 1.25 million shares for himself. All right, so we probably need to type that in. Bruce Wayne's shares, 1.25 million shares he plans to keep. He also plans to hold back an additional 200,000 shares according to the green shoe provision. If you're not familiar with this term, see chapter 15. It talks about what that is. We're going to document it. So the green shoe provision, 200,000 shares. All right. And then he also plans to pay off some venture capitalists with 520,000 shares. So instead of compensating them with money, he's going to compensate them with equity in his firm. So he's going to issue shares of stock to the venture capitalists that helped him get on his feet. And then he plans to sell the remaining shares to the public at $15.24 per share. All right, so we're given this information here, 1524. All right, so we have that information. And then, of course, the question is well, how many shares even remain? Simple math. We're going to take the authorized amount, and we're going to subtract all of these reserves that he's holding on to for various reasons. And so it looks like the shares that are actually going to be issued out for auction are about 3.15 million. That's what remain. Okay. And so let's say now it says, given the bids at auction, see table below. And I think this table, I pulled it right out of my finance lab. It says distribute the shares to all bidders using a pro rata share procedure. Assume that Berkman Investment Bank takes its green shoe shares. What is the total cash flow to Wayne after the sale? And what is the total cash flow to Berkman Investment Bank? Alrighty. Okay. So we're told that when we take this 3.15 million to auction, these are the bids that we received with a total. There's a total line down there. Okay. So when you receive bids, it's for numbers of shares. And in real life, it's also for prices, right? And those prices normally will dictate the price per share that we actually uh, decide to sell for. But in this problem, they keep it pretty simplified, and we're only focused on how many shares of stock each investor here wants for themselves. Now, what you will notice is that this number here exceeds this number here. And that's where the pro rata ratio comes in. So we want to make sure that every bidder gets a proportionate sum of shares that is equal to the proportion to the proportion that we have available. And the way that we do that is we take the number of shares available and we divide it by the number of shares that were bid on. Okay, the total. All right. And so what we get is a ratio of 0.68 to 1. Remember, ratios are they're not just one answer. It's not just 0.68. It's 0.68 to 1. So for every share that was bid on, we have 0.68 shares that we can shell out. And so we want to keep that ratio equal as we issue shares out to our individual investors that stepped up and said they wanted to buy in our stock. All right, so how does that work? So pro-rata rations. We'll call this rations. I'm not sure if your book calls it rations, but that's what I'm going to call it. And so we're literally going to use that ratio, and we're going to take the amount that each investor or firm bid on, and we're going to multiply it by that ratio there. All right, and then I'm going to anchor it. Okay, and so what this does is this keeps that ratio alive. So this number represents 0.68 of the number of shares that Gotham Pension wanted, right? So 140, what is that? Not 140, that's 1.46 million shares represents 68% of the 2.15 million that Gotham wanted. Well, let's continue that formula down. So we're going to draw all that down, all the way down to Barry Allen, right? And then we can even check the math. We can say, okay, let's make sure that this comes out right. And if you drag this down, right, you're going to get, oh, look at there, you get 3.15 million. And remember that 3.15 million represents 68%, right, of the quantity that was bid on. So what this is this is guaranteeing that each bidder gets a proportionate amount of shares that they bid compared to what we had available to sell to them. All right, so that's where those answers come from. Hopefully everybody's able to follow along. Let's go all borders. There we go. And then, so that answers that part of the question. Then it says, what is the total cash flow to Wayne after the sale and to Berkman Investment Bank? Well, we don't even really need this information to determine that, do we? So if you think back to the earlier problem that we solved, the first thing we need to do is determine what the gross proceeds were from the sale. So after we give out all of these shares, and these are the ones that remain, we're selling that total at $15.24 per share. So we're going to generate about $48 million. Okay, but we were told earlier that Berkman is going to take a commission, right? So their commission has to be reduced, right? Just like we did in an earlier problem. And so we're going to take the gross proceeds and multiply it by that commission rate. All right, and then what we're going to do is determine the net proceeds based on that, removing that commission there. So we're going to take this amount minus this amount. And so what we get is we get that Bruce Wayne's cut is about $45.84 million. And Berkman Investment, their cut is about $2.16 million in commission. And that's all I got for you folks. That's the last two problems that I hoped to be able to demonstrate in class and just ran out of time. I hope these help you on your homework and your quiz for this week. As always, if you need any help, please let me know. Otherwise, I hope you're having a great week and we'll talk to you soon.